Bringing us home today is BNK Banking Corporation, ASX code BBC, with a market capitalisation of $41.6 million. BNK is a digital-only banking platform that has been enhancing the banking experience for Australians, offering personal, intuitive and convenient financial services through a network of third-party aggregators. Presenting today is Allan Savins, the CEO. Allan, please take it away.
Thank you, Peter. Good afternoon, everybody. Yes, my name's Allan Savins, and I'm the CEO of BNK Banking Corporation, and I'm delighted to participate in today's event and to showcase the BNK story. BNK operates as a publicly listed authorised deposit-taking institution under the regulation of APRA. BNK holds an unrestricted banking licence functioning within the Australian financial services sector. So I'm pleased to take you through an overview of the company and our FY24 full results. Next slide, please. This deck is actually on our website, so I won't run through each particular point, but it will showcase a few points. But the key point in this is that, to be clear, we're not a fintech. We've been operating in financial services for the past 42 years, writing loans and taking deposits. A strategic shift in the business model occurred in September 2018 when the bank merged with mortgage aggregator Finsure and non-bank lender Better Choice Home Loans to uplift and enhance its distribution, underwriting and loan servicing capability. This saw the strategic shift in 2020 to close the two branches, and origination became prominently online through third-party intermediaries. Important to note that all loans for BNK are sold under the brand of Better Choice, not the brand of BNK, and deposits are currently sold under the brand of Goldfields Money. Funding diversification was established in 2021 through the establishment of a Bendigo and Adelaide Bank Prime residential warehouse and an off-balance sheet Goldman Sachs specialist residential warehouse, where the bank receives management fees to run that program. In February 22, saw the Finsure business sold for $152 million, which was 30 times cash earnings and 2.5 times book value. And that resulted in the bank being well capitalised and underpinned our expansion into higher margin SME business lending in August of 2022. Next slide, please. Who we are and what is our value proposition. We are a bank for enterprising Australians. We've demonstrated a track record of lending growth. The BNK loan book is now at $1.37 billion, with 81% representing the prime residential home loans, which I'll touch on shortly. We have experienced strong compound annual growth rates over the past 3 years to June 2024. And again, I'll touch on that shortly. Importantly, we have a diversified funding base. We have $1.27 billion of customer deposits as at June 30, with a customer deposit to total loan ratio of 93%, which demonstrates our ability to raise deposits and fund growth, and a strong capital adequacy ratio of 23.4%, which is well above our prudential and board limits. We have a wider shelf front of products than most smaller ADIs, whether it be prime residential or commercial loans, plus the added benefit of the Goldman Sachs off-balance sheet funding line. This enables our mortgage partners to offer a greater array of products, or solutions as we prefer to call them, all with the same lender to attract new customers and retain their existing customer base. And the expansion of the higher margin SME market has been made possible due to the existing broker network, which now stands at approximately 12,000 accredited mortgage brokers throughout Australia. Next slide, please. Our results overview in terms of FY24, our financial results showed an improved trajectory. The challenging market conditions faced by the banking sector persisted throughout FY24, but despite this, the underlying NPAT loss narrowed to $900,000, being an improvement of $600,000 from the previous corresponding period. Further, the second half 24 underlying NPAT was positive at just under $300,000, up $1.5 million on the first half of 24. And on particular note, the second half saw the last 4 consecutive months of positive underlying NPAT. Some other call-outs: the intense market competition on interest rates, combined with the composition of assets and liabilities and rising wholesale funding costs, did lead to a 9 basis point decrease in the net interest margin, bring it down to 1.06%. But that decline did reflect a trend that was observed across the entire banking sector. But importantly, our net interest margin for the second half of 24 saw a recovery, as we foreshadowed in our half-year results, and was up 28 basis points on the first half of 24 to 1.2%. Next slide, please. Some of our overall performance for the year. The first column shows our statutory outcomes. The next column, our underlying results, and third column comparing underlying FY24 to underlying FY23. Our net interest income of 19.3 million was up 3% year on year. Our other income was a net reduction in statutory terms, with the net present value impact of a legacy mortgage management book, which we no longer run, but we still service, and increased commission expense. In underlying terms, it also reduced due to lower overall fees and higher commission expense across the full year. Our underlying expenses were down 6% year on year, with $199,000 of expenses associated with the start of our Phase 2 core technology upgrade. The carrying value of our goodwill was reassessed, and a decision to write down $3.6 million is reflected in our statutory results. This reflected more of our prime residential business, which we are no longer necessarily targeting, so we thought it was appropriate to reduce that carrying value. The summation of the above led to $6.7 million loss for statutory results, a $917,000 loss for underlying, which is a 40% improvement on the underlying result for FY23. Next slide, please. Our key metrics, our balance sheet footing showed modest growth year on year, consistent with our strategic aim of moving away from prime residential loans. Our underlying cost to income ratio remained relatively flat year on year. Our capital ratio improved on both the Tier 1 and the total level. We improved our liquidity ratio, and our net tangible assets remains around $1 per share. Next slide, please. Our second half underlying performance improved on our first half, as I've mentioned. Our net interest income increased by $2.2 million to $10.7 million, up 25%, driven by, of course, the NIM uplift. Other income also improved, predominantly from higher origination fees from the Goldman Sachs off-balance sheet program. Conversely, our underlying expenses are up $770,000 or 7% to $11.1 million, largely reflecting an increase in technology, professional fees and marketing, with the half one slightly lower than normal. Our credit provision expense was a small write-back as the prime book reduced and our arrears showed signs of stabilising. The summary of the above led to a positive underlying NPAT for the second half 24 of $270,000 compared to an underlying loss in the first half of just under $1.2 million. And importantly, our second half 2024 cost to income ratio reduced to 97%. Next slide, please. Our loan book in FY25, the strategy focused on prioritising growth over growth that doesn't meet our cost of capital. As a result, the company shifted away from low margin prime residential loans, as per our previous guidance, and concentrated on optimising the loan book composition. We retained a good portion of our fixed rate loan maturities coming off low rates and grew our higher margin assets. So in summary, the loan book held steady at $1.37 billion, as previously mentioned. Thus, the deposit book also remained stable at $1.27 billion. The last 12 months saw a modest increase in the net interest income, reaching $19.3 million as previously outlined, continuing the upward trend observed in previous years. The growth rate has slowed compared to increases in earlier periods, attributed to heightened competition, deposit customers transitioning to accounts with higher yields, and elevated wholesale funding costs. Next slide, please. For our fixed rate home loans, they provide a continued margin uplift potential. We've been relatively successful in helping our customers transition from higher variable rates on maturity, with an average retention of approximately 60% through FY24, which is broadly in line with our internal targets. The fixed book continues to reduce and the forward profile shows the maturities over the next 3 halves, by which time we'll have very little left of the residential portfolio on fixed rates. Subject to us continuing to successfully retain customers, this should further assist the margin outlook. Next slide, please. Our lending portfolio remains stable from a risk perspective. There's minimal variation in the portfolio payment type, with over 80% of the loans maintaining a structure of principal and interest, despite the pivot into higher margin assets. This indicates reduced portfolio risk as borrower equity continues to accumulate. No change in the portfolio loan type, with a modest increase in investor lending. High margin assets now comprise 19% of the portfolio, secured by either residential or commercial property. These are not short-term loans. They are full-term loans over 25 to 30 years. The goal set 2 years ago was 30% of the portfolio in this cohort over the medium term. So we're well on track to achieve this. And with the shift in the higher margin lending, the loan to value ratio mix at settlement has steadily improved and remains strong, with greater than 90% of the portfolio having a loan to value ratio below 80%. Next slide, please. Our portfolio metrics continue to be healthy. There's been a slight decrease in offset account balances from 89 million to 79 million over FY24, consistent with some of the reduction in our prime residential book. Approximately 44% of all loan accounts are still ahead in their payments, slightly down from 49% a year ago. And these metrics continue to provide an effective buffer for our borrowers. Mortgage in possession rates is maintained at zero, together with no credit write-offs recorded during the year. And the fixed rate book now makes up 8% of the portfolio. And there's no new fixed rate business currently being originated onto the book, onto the balance sheet. Next slide, please. In terms of our credit quality and arrears, the increasing borrowing rates for customers has led to an increase in arrears over the course of FY24. Our greater than 90 days arrears as at 30 June sat at 0.79% of the residential loan book and represents 18 accounts. So to put that into context, we have 3,560 accounts across 2,700 loan customers. The aggregate total for 31 days plus sits at 1.64, which is consistent with the total as at December 23, though 90 plus has increased since then, but down from Q3 when the aggregate 31 plus total was 1.76% and 90 plus was 0.97%. Our commercial arrears remain within tolerance with 3 customers in our 90 plus days category, which is a reduction of 4 from March. While there are still pressures on households, the portfolio has shown signs of stabilising, and we believe we're well provisioned. Our arrears numbers have come from a low base, and they're not inconsistent with what we've seen across the country and recently reported outcomes from other ADIs. Next slide, please. The executive team is a very experienced team. I'll leave you to review, but we all have minimum tenures of 30 years plus in the financial services industry. I'm at 40 years plus myself. I've been BNK for 6 years since the merger of Finsure. My original position was general manager, and I was promoted to CEO in January of 2022. Next slide, please. We have a highly experienced board driving our next phase of growth, led by John Denovan, Special Counsel and Dentons. Some other call-outs, David Gratian, First Mac board member, and Warren McClelland, non-executive chairman of Resimac Group associated with Summers, and both of those entities are being part of our 2 largest shareholders. Next slide, please. So just in conclusion, the goal is to deliver sustainable underlying profitable growth in FY24 and build on the second half underlying momentum. And the margin traction gained in the second half of 24 does provide that momentum into FY25. High margin assets and high return on capital opportunities will continue to be the primary area of focus. An essential factor for achieving sustainable profitability continues to lie in the composition of the portfolio. A greater concentration of higher margin assets reduces the necessity for a larger loan book to attain optimal profitability. The growth target is to reach 30% concentration of higher margins, and this will be achieved by optimising risk-weighted assets and reallocating capital to support loan growth, with a continued emphasis on cost discipline as a key driver. And the company continues to be judicious with its capital and has no plans for a capital raise this financial year. So we've made solid progress in 2024, despite facing intense competition and inflationary pressures. Our purpose-driven strategy to focus on higher margin and capital-efficient assets, coupled with disciplined cost control, is gaining traction. We've demonstrated that our emphasis on higher margin assets reduces the need to solely pursue the loan book expansion to attain sustainable profitability. So thanks for the opportunity to showcase BNK, and I'll happily take questions. Next slide, please.
Allan, thank you for the presentation. We do have some questions. Just on one of your slides, you had the 37% CAGR in loans. What factors have contributed to such a rapid growth in the last 3 years? Are there any specific market segments or product areas that is driving this growth?
That's a good question. It's basically relationships. The benefit that the Better Choice merger brought with them was distribution. So the Goldfields previously just had distribution access through their two-branch network. So we've brought access now to 12,000 brokers across the country, which means more entry points to sell our products. So by having a sales team on the ground nationally, selling our products and building relationships with our brokers, we've gained traction. And it's that cliche of service, but we very much believe in that value proposition of service for our brokers. And effectively, that's what's underpinned the performance.
And Allan, you've made your focus in the SME market well known. Is there any potential to expand in the bigger end of town eventually?
Not at this particular point in time. We do things in a very considered way, and given we've just pivoted into the commercial higher margin in the last 2 years, it makes sense just to understand that cohort better before we have any appetite to expand further into the higher end of town, as it were.
Yep, for sure. And just lastly, how does the company leverage its existing broker network to expand its reach and attract more business?
Yeah, so we sit on mortgage aggregation panels. So we have our products sit as a lender on all those particular panels. So that gives, I guess, line of sight and access to all those broker customers to our products, and then followed up by BDM support.
Allan, thank you so much for your presentation.
Thank you, Peter. Thanks, everybody.